Is the debt ceiling mess in Congress the one thing that will derail the housing market this year? Up to this point, we know that even at these relatively high mortgage rates, there are more buyers than sellers. We know that while home prices are lower than last year, they have not been falling from here. And we know that buyers are basically buying everything available this spring. But also in this moment, mortgage rates have been slowly rising, approaching 7% again. And some of that is driven by the debt ceiling uncertainty in Congress. The potential U.S. government default adds significant risk to mortgage rates, as well as the economy in general. Home buyers don't use that in their calculation now until it's actually happening. So a major shock could slow down home buyers abruptly. In our Altos Top of Mind podcast a few months ago, I interviewed Zillow economist Orfi Devingue, who first highlighted the risk to me about the debt ceiling crisis, and it's now upon us. But fingers crossed that we get past this moment without too much damage. It is a risk that could derail this surprisingly strong housing market so far this year. So every week, of course, Altos Research tracks every home for sale in the country. We analyze all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. That's why if this debt ceiling crisis hits us hard, we'll see it in the data very quickly. I'm Mike Simonsen. I'm the founder of Altos Research, and let's look at the data for May 22, 2023. The median price of single-family homes in the U.S. this week is $450,000, which is basically unchanged from last week and also the same as it was last year at this time, roughly. Last year, there was still momentum in the market from the tail end of the frenzy. So some prices were at an all-time high to end the second quarter last year. So our year-over-year comparisons are now versus the absolute peak of home pricing strength from the pandemic frenzy. That's why the median price of the newly listed homes this week is 3.5% below where homes were being listed last year at this time at $415,000. That's actually down 0.7% from last week too. It's not uncommon for the price of the new listings to peak in early May and start ticking downward. And it looks like the peak of pricing of the new listings, that's the light red line here, peaked in the first week of May this year. So that's not unusual. Last year, the new listing prices peaked at the end of May, and it was July when we could really see the new listings prices falling rapidly each week. So in the light red line here, you can see the big steps down in July last year. Those were much bigger, steeper price adjustments than most Julys. So we'll see what this July brings. If the debt ceiling crisis and mortgage rates spike, it'll take some time, a little time for that to show up in home prices. During the initial pandemic lockdowns, for example, it took about 3 weeks for home prices to tick down a little bit from mid-March to early April. Then by mid-May 2022, it was clear that homebuyer demand was accelerating, so prices had started to rebound. The pandemic lockdown created about 5 weeks of buyer opportunities in the housing market. There are now 424,000 single-family homes on the market across the U.S. That's up 0.9% from last week. Available inventory from home sellers continues to follow the path it has all year: restricted supply and more buyers than sellers. We started the year with 75% more homes on the market than the year previous. Inventory built last year as home buyers slowed, but the sellers never really showed up. So the inventory build last year was from buyer demand weakening. This year, the buyers have resumed, and they've gobbled up all the available inventory. Most years by mid-May, Inventory has increased. It has grown 15 to 20% over the start of the year. In 2023, available inventory has shrunk by 14%. It's a big difference from normal. So at what point do you call this a hot housing market? I don't know. It's crazy, and it continues to surprise. There are multiple offers, and buyers are pretty much buying everything that's available. It's been a kind of hot spring market for real estate. It's sort of hard to utter these words given the year we've had and the economic signals all around us. When the debt ceiling shocks the market, it may not, though, result in more inventory. Sellers are scared too. They don't sell, they postpone. Some sellers withdraw and leave the market. So there was no jump in inventory during the initial lockdown phase last year, or in 2020, for example. Both buyers and sellers slowed for those few weeks. So we'll watch the new listings numbers very closely over the next few weeks. New listing volume has been so low this year, it would surprise me if economic uncertainty suddenly changed that trend. We will see the impact of debt ceiling crisis very quickly in the pace of the home sales each week. Home sales, as measured by the pendings here, has been steadily climbing all year, bouncing off of 2022's dramatic decline. With 398,000 single-family homes in contract, that's 14% fewer than last year at this time. But in December and January, the pendings count was 30 to 35% fewer than last year. So home sales have been recovering. A debt ceiling showdown with dire consequences will delay offers from being made. It'll delay shoppers. It'll also delay deals that are already in contract from closing. I like this view here of unsold inventory next to the sold inventory, the pendings. So last year, inventory was rising quickly and sales were not. There were still, at that time, more homes in contract than were actually available on the market. The light color bar here are the inventory count each week, and the dark bars are the pendings. You can see how the pending sales are now rising while inventory is not. It's inverted from last year. With only 398,000 single-family homes in contract, there are still fewer home sales than normal this time of year. The seasonally adjusted home sales numbers will report. They'll still report very low for May, but each week we're recovering a bit more. If Congress manages to avoid crisis with the debt ceiling, by July, we may be running ahead of the sales pace compared to the second half of last year. We'll keep an eye on the pending sales rate each week, at least until the debt ceiling mess is resolved. We keep track of the pendings price too. The median price of all the single-family homes in contract is basically unchanged this week at $384,000. So that's 1.5% below last year at this time. And man, it looks to me like if we don't have these external shocks, we could finish the 2023 with home prices level or maybe even fractionally higher than the end of 2022. This is the median price of all the single-family homes in contract. So these are sales that are pending now, will complete in June and July. Prices are currently running below last year, but that momentum is changing. And remember that the sales prices are the most backward-looking, lagging indicator in all this data that we share. And so it will be true that if mortgage rates spike or credit availability craters due to default or some other government certainty, like you'll see that show up in the sales prices last. Price reductions ticked up, as you'd expect for May. 29.9% of the homes on the market have taken a price cut. So far this year, the housing market has been hot enough and homes moving fast enough that we've had fewer and fewer price reductions each week. The dark red line here is this year's curve, and it's only now starting to rise for the year. When homes get listed in April and May, and then they don't have offers yet, by the end of May, they need to do price cuts to get moving. So price cuts accelerate in the second and third quarter. They peak in the fourth quarter, and before resetting before the end of the year. With an acute crisis, as we had in 2020, price cuts don't spike immediately. But I expected at that time price cuts to start rising. And when they didn't, it was an early sign of market strength. In April and May 2020, we were all assuming that the real estate market would crater and we'd see panic quickly. Many people held those assumptions way too long. And one place we could see the surprising strength is in the price reductions data. So keep your eyes here if the government throws us into a new crisis this spring. Never a dull moment in real estate. The basic fact remains true. Home buyers and sellers need to know what's happening. They have a lot of opinions and a lot of noise to filter. So if you need to get them the actual data as soon as it becomes available, if you need to communicate about the housing market to buyers and sellers, go to altosresearch.com and just book a free consult with our team. We'll help you interpret the crazy market, the local market for your clients right now. It's a critical time to be informed, so please join us.